What Japan's economy could look like in the next decade. This is Japan, the third largest economy in the world and potentially one of the most important countries for predicting what the future might look like over the next 10 years. Simon Kuznets, a Nobel Prize-winning economist and namesake of the Kuznets curve, once observed that there were 4 types of economies in the world: developed economies, underdeveloped economies, Argentina, and Japan. This was a very ironic way of saying that these countries have never really followed the conventional wisdom on how national economies should operate. If you find the video you watch useful, we invite you to subscribe to our channel and support us with a donation. Your help is precious to us and will allow us to continue producing quality content for you. You can do it here below, through the appropriate buttons, subscribe, and thanks. Argentina is a whole other story, but some economists are starting to theorize that Japan is not unusual at all. It's just ahead of its time. Japan was once the second largest economy in the world, and in the 1980s, people thought it was almost inevitable that it would overtake the United States, fueled by enormous export industries and a rapidly developing domestic market. This might sound familiar to many of you today. However, since its peak, the country has been stagnant with no real growth in the last 3 decades. To combat this stagnation, the Japanese government was the first in the world to implement unprecedented economic measures at the time, but which sound very familiar to us today: quantitative easing, negative interest rates, and constant deficit spending. Unfortunately, none of this has really worked, which is pushing some of the world's greatest economists into interesting and potentially very concerning discussions. Is there something unique about the Japanese economy that is causing this stagnation? Or is it finally time to admit that infinite growth in a finite world is not sustainable for any economy? And if Japan is truly ahead of the curve, what can we learn about economic stagnation, inflation, and government intervention from the country's experiences over the last 3 decades? Naturally, once we've done all that, we'll put Japan, the third largest economy in the world, into the national economy ranking. This video is brought to you by Public.com, the first internet investment platform that puts its investors first. Unlike other commission-free trading apps, Public does not sell information about your trades to market makers or take commissions for payment for order flow, also known as PFOF. Public doesn't work for you as a trading company. The app also allows you to see market trends that your friends, colleagues, and industry thought leaders are following to give you even more information. Public users can participate in live Q&A sessions called town halls with executives of public companies, allowing you to ask questions just like a Wall Street analyst. Get between $3 and $300 in free stocks when you sign up on Public.com and fund your account today. Simply use your phone's camera app to scan the QR code on the screen, or if you're watching on your phone, feel free to click the link in the video description below. The story of Japan's modern economy really begins in the mid-1980s. At that time, the country had completely recovered from the impacts of World War II and had rebuilt itself into an economic powerhouse that rivaled the United States. It was building everything from affordable, reliable cars to cutting-edge electronics. This was made possible by a new global push towards free trade, which meant that the resource-poor island nation could focus on high-quality production, relying on other nations for raw materials, food, and anything else that would be difficult to produce within Japan itself. This is a textbook example of comparative advantage. Countries like America are brilliant at agriculture but not so great at producing consumer electronics. Countries like Japan were great at producing consumer electronics but not so great at producing food. If both countries focused on what they were good at and traded with each other, it would mean more food and electronics for everyone. The good times were good, and sustained double-digit growth meant that most Japanese citizens had seen their quality of life improve significantly over the course of their careers. But, of course, this did not last forever. In the United States, the U.S. began to worry that its domestic production was starting to be outcompeted by countries like West Germany and Japan, especially in the automotive industry, which was still a big job provider for all these nations. The normal solution to this problem would have been to implement trade restrictions, imposing a tariff on every Japanese car and VCR that arrived on American shores, and suddenly American products would be competitive again in terms of cost. But this is far from being resolved. If America had introduced trade restrictions on Japan, then Japan probably would have returned the favor, which would have meant that American exporters would lose business, and it would also have meant that American and Japanese citizens would be in a worse situation because they would be forced to buy more expensive products from producers that had been artificially protected from global competition. So, some sort of compromise was necessary. What the countries came up with was a plan to artificially lower the value of the US dollar relative to the currencies of West Germany, France, the United Kingdom, and Japan. This plan was signed by the 5 participating countries in 1985 at the Plaza Hotel in New York, from which the plan took its name, the Plaza Accord. If US dollars were worth less, American citizens would have less purchasing power for foreign products, and citizens of all these other countries would have more purchasing power for goods made in America. This would make American producers more competitive both globally and domestically, not a bad deal for the Americans. But why would Japan, a country heavily dependent on exports, accept something like this? The first reason was that they didn't have much choice. If Japan had not accepted this agreement, then the pressure from American producers would probably have forced the American government to impose trade tariffs on Japanese imports. This would have been worse for Japanese companies than a simple shift in the exchange rate, and it would also have been worse for Japan as a whole. Sure, they exported more to America than they imported, but America relied on them only for cheap cars and sophisticated home theater systems. In Japan, the contrast depended on America for food and many of the raw materials needed to build all the products they exported in the first place. For this reason, the Plaza Accord was seen mainly as a win-win situation. America became more competitive in production, and Japan became everything cheaper. When the Japanese yen appreciated, Japan was able to go on a shopping spree with its newly more valuable yen. The nation's citizens bought everything from American vacations to American companies. Japan had worked hard as an industrial workshop for 4 decades and had done well for itself, but the Plaza Accord made it rich in the span of 3 years. The relative value of the Japanese people's money had more than doubled. Tokyo at the end of the 1980s was the world capital of hard work and fun. Jordan Belfort couldn't keep up with how much Japanese businessmen spent on their parties. Just in 1989, $50 billion, the equivalent of $113 billion today, was charged to corporate expense accounts in Tokyo. In addition to the wild parties, this had a very concrete impact on the economy. The value of the real estate and city centers market exploded to a point never seen before and never seen since. If you laid a $100 bill on the ground in Ginza at the end of the 1980s, the ground covered by the bill would be worth more than the bill itself, and again, this was in 1989. To throw gasoline on the fire, the Bank of Japan lowered interest rates as a preventive measure to reduce the impact of lost exports. Instead of doing any of that, this cheaper money was mainly used to speculate on the stock market and real estate. It may seem silly to us in hindsight, but many people genuinely believed that Tokyo would become the new center of the world, and if a few things had gone differently, perhaps they wouldn't have been wrong. But unfortunately, as you may know, the boom of the 1980s did not last forever. Instead, it gave way to the beginning of stagnation. The real estate and stock market crash of the early 1990s put Japan in a very difficult position. Its banks now ran the risk that people would not pay for their homes, which were worth only a fraction of the mortgage price. The same problem also existed for companies in Japan. People had just seen their net worth evaporate overnight, and in many cases, they were still left with crippling debts used to fuel the extravagance in the first place. The consumer culture shifted very rapidly from lavish extravagance to modest frugality, causing the collapse of consumer spending. As the demand for goods decreased, so did their prices. The general reduction in the level of prices for goods and services is called deflation. You might think that sounds like a good thing, but most economists are actually more afraid of deflation than inflation, and Japan was about to find out why. As prices fell, companies earned less from selling their products. Less money from sales meant that companies had to postpone giving raises or even lay off staff, reducing household incomes. Reduced household incomes meant that people had less money to buy things, which reduced demand, which reduced prices. It's a vicious cycle that is really hard to fight. Making matters worse, as the relative value of the yen increased, so did the debts denominated in that currency. If you took out $1 million loan to buy a house and then deflation set in, making that $1 million worth twice as much as it once was, you would be in a very tough spot in making those repayments. The Bank of Japan tried to combat this phenomenon by lowering interest rates, but it had little effect. Economists call the 1990s in Japan the lost decade, but this doesn't mean that the 2 decades that followed were much better. When the 2000s arrived, Japan had, in a sense, recovered from its debt hangover, but it was then hit by a new downward pressure. For a long time, Japan was the go-to place for low-cost mass production, a role that was still useful to it despite the Plaza Accord and the slowdown of the 1990s. But when China opened up to global trade, Japan soon realized that it could no longer compete on price or quantity in international markets. It was during this period that Japan also began to realize that its young, productive population from the 1980s was aging and retiring. This put a strain on younger workers and social programs that took care of people who were no longer giving back to the economy that supported them. This aging population problem is not exclusive to Japan. Most advanced countries have birth rates below 2 children per woman, which means that their populations are aging over time. That said, this problem is more pronounced in Japan. This is because the Japanese live for a very long time, but there has also been a cultural reluctance to rely on immigration to rejuvenate the workforce, as is common in most other advanced economies. Throughout this period, the Bank of Japan lowered interest rates again and again in an attempt to combat these problems and get the economy moving, but unfortunately, it had very limited impact. In response to this, the Bank of Japan became increasingly desperate to try new strategies to stimulate the economy and get inflation back on the right side of negative. The biggest hammer they had in their toolbox was quantitative easing, a term we are all too familiar with today but which was considered very radical when Japan first used it. Quantitative easing involves a central bank creating money and then using that new money to purchase assets on the open market. Normally, these are government bonds, but in the case of Japan, the central bank embarked on a series of purchases of practically anything it could get its hands on: government bonds, corporate bonds, and even stocks. Today, the Bank of Japan is the single largest holder of Japanese corporate stocks. The idea behind this plan is that it puts money directly into the hands of whoever is selling these assets. If the bank buys government bonds, it gives the government money to spend on building roads or social programs. If the bank buys corporate bonds, it gives companies money to build new factories and offices. And if the bank buys stocks, it might well give money directly to ordinary consumers to spend in the economy. So why didn't it work? Despite low interest rates and heavy quantitative easing over the last 2 decades, inflation in Japan has remained stubbornly low, hovering around 0%. Some economists point to this as something that should comfort us. If sustained low interest rates and quantitative easing did not cause any inflation in Japan, it is unlikely to cause hyperinflation in our economies. So, is this a reasonable expectation, or is Japan special? There are some reasons to expect that the situation in Japan might be different from what is currently happening around the world today. The first is the time frame over which the United States has conducted heavy quantitative easing over the last 2 years rather than the last 3 decades. Distributing money injections over time means that participants in an economy have more time to react. Doubling the money supply in 20 years is probably not a big problem. Doubling the money supply in 2 years might be. The second big difference is on the supply side of the economy. Apart from the aging population, there is not a big difference between Japan's productive capacity today and its capacity 3 decades ago. If an economy has $5 and 5 loaves of bread, then each of those loaves should cost $1. If the economy suddenly has 100 loaves of bread and $100, then each of those loaves should still cost $1. Of course, this does not account for a range of factors: the elasticity of demand for bread, products competing with bread, and the general population's tolerance for gluten. But you get the basic idea. If the money supply increases and so does the aggregate supply, then there is no reason to expect prices to increase. The supply side has been heavily hit in most countries around the world today. Waiting lists and empty grocery stores are things we are becoming all too familiar with. The third big reason is something that is much harder for economists to account for: the professional and consumer culture of Japan. It is incredibly taboo to ask for a raise in Japan, and because the workforce is aging, it is also harder to get a promotion or change jobs for better pay because the corporate ladder is full of people who have been with their companies for decades. This means that disposable incomes have remained almost entirely stagnant since the 1990s. Compare this with the United States, where workers are much more active in asking for raises, promotions, and new job opportunities, and you can see that personal disposable income has increased dramatically over the same period. A brief side note is that the spikiness of this graph is due to the fact that Japan collects its data quarterly, so it is subject to seasonal changes around holidays and bonus periods. The United States collects its data annually, so these spikes are, in a sense, simply smoothed out. On the other side of the same coin, Japanese consumers are incredibly cost-conscious and demand stable prices. Japanese companies are known for issuing public apologies for raising their prices even by just 10 yen, the equivalent of about 10 cents. The same cautious approach to finances also spills over into companies. When American companies receive a big injection of money, the first thing they think about is how it can be reinvested in the company. In contrast, Japanese companies have historically preferred to simply return that money to their investors, which must be really frustrating for the Bank of Japan, since they are the largest investors in those companies and are trying their hardest to give them money. Ironically, the expectation of inflation can cause inflation. If people expect prices and wages to increase, they will accept higher prices at the supermarket and ask for a raise every year. If this expectation is not there, they will be angry about price increases and content with wage stagnation. Japan's economy is infinitely complex, and there is a good reason why it is one of the first countries we have ever explored on this channel. It is also the reason why some of the world's greatest economists are totally baffled by its behavior. We can learn a lot from Japan, and it is a great example of money printing not necessarily leading to inflation. But we must also respect its differences as much as we draw conclusions from its similarities. Now it's time to put Japan, the third largest economy in the world, into the national economy ranking, starting as always with size. Japan has a GDP of just over $5 trillion, which would be impressive in its own right, but it is even more impressive when you consider that it has had this impressive figure for almost 30 years now. In any case, it gets a 9 out of 10. GDP per capita is also very strong, at just over $40,000 per person, making it a decidedly advanced economy, but it still lags behind countries like the United States, Germany, and Australia, where it gets a score of 8 out of 10. Growth has been notoriously very poor. The country's economy has not had consistent growth since the 1990s. The good news is that it is not going backward, so it gets a score of 2 out of 10. Stability and trust are very strong. It is a stable, democratic, and diversified nation with a strong currency and good international relations. It gets a 9 out of 10. Finally, industry. Well, what can we say? It does everything from world-class cars to some of the most valuable media franchises in the world. Japan gets an easy 10 out of 10. All in all, this gives Japan an average score of 7.6 out of 10, placing it second in the national economy ranking. What was your experience with the topic covered in this video? Tell us about it in the comments, we are curious to know. And if you have any doubts or questions, don't hold back. Leave a comment, even just a simple like would be perfect, but most importantly, subscribe to the channel to stay informed about upcoming releases.